Hi guys, welcome back to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Wednesday morning, the cues aren't looking all that encouraging for our markets. GIFT Nifty hinting at a flattish start. And if you look at what happened globally overnight, we saw a tech-led sell-off on Wall Street and Asian markets also not doing all that well. So yes, we are looking at a flattish start, but let's hope that we can maintain the kind of up move that we saw yesterday. Although we did come off the day's high, the recovery after Monday's sell-off was quite feeble, and until and unless we reclaim that 200-day moving average level of 23,915 or thereabouts, the confidence may be a little shaky at the current juncture. So yes, lots to digest, lots of stocks in focus, including the likes of Reliance Industries, Dr. Reddy's, even some bit of news flow on Zomato. Yesterday, the stock saw a drubbing of 5% or thereabouts on the back of a downgrade coming in from brokerage house. Let's see today or today if it can stage a recovery or not. But lots lined up over the next half an hour. Keep your queries coming in as well on our live feed. We'll try and take them up with our experts on the show. But before we move any further, let's quickly take a look at the top stories at this hour. The Nasdaq dips nearly 2% in a tech-led sell-off on Wall Street as Treasury yields hit their highest level since April 2024. The S&P 500 slides over 1% after strong services data raises concerns over the Fed's rate cut path. Asian markets trade largely lower following a weak handover from Wall Street. The GIFT Nifty is also suggesting a muted to negative start for our markets. In the pre-open session, we are mildly higher. Let's see what the day holds for us. Brent rises above $77 a barrel mark on expectations of tighter supply and higher demand from China. Meanwhile, gold pairs gains as treasury yields rise and the US dollar strengthens. And the government projects GDP growth for this fiscal at 6.4% in its first advance estimates. This is the slowest pace of growth in 4 years. Manufacturing sector likely to see the sharpest slowdown. Well, then let's quickly take a look at the cues for trade. Then, as I mentioned, in the pre-open session, we are seeing a very mild uptick on the Nifty. In fact, it is somewhere around 40 points higher at the current juncture. Yesterday, we did try to make a comeback after the knee-jerk sell-off that we saw in Monday's session, but we came off a good 100 points from the day's high. And towards the end of the session, we barely managed to end higher by 0.3% or thereabouts. So yes, the confidence, so to say, is lacking. Sell on rise. That's the kind of strategy that traders and investors seem to be adopting at the current juncture. Important to note that both the Nifty and Nifty Bank are below the 200-day moving average levels, and until and unless those levels are reclaimed, the strategy could largely be sell on rise. If you look at yesterday's action, markets did end higher. The Nifty ended above that 23,700 mark. But mind you, at one point in time, it was trying to reclaim that 23,800 mark as well. But it failed to do so really. If you look at the broader end of the markets, they were outperformers yesterday. In fact, even the advance decline ratio was in favor of gainers. Heavyweights like Reliance Industries, ICICI Bank, these are some of the stocks that contributed most to yesterday's gains on the Nifty. ONGC was the top gainer and it rose somewhere around 4% after CLSA upgraded the stock. Life insurance stocks also saw some bit of an action. But in terms of options cues, the Nifty put call ratio rose to 0.82 vis-a-vis 0.72 in the previous session, and some of the stocks that will be in F&O ban are the likes of Hindustan Copper, Manappuram Finance and RBL Bank, and there is a new entrant as well, Bandhan Bank, that has entered the F&O ban list. But a few stocks will be added to the F&O universe from the 31st of January, and 6 stocks have made the cut. They are the likes of Castrol India, Gland Pharma, NBCC, Phoenix Mills, Solar Industries and Torrent Power. In terms of fund flows, foreign investors remain net sellers to the tune of 1,490 crore rupees or thereabouts in the cash markets. But DII buying support is consistently coming in, with the domestic investors buying somewhere around 1,600 crore rupees worth of stocks in the cash markets. But let me bring on board our technical guest for today. Joining me is Rajesh Palviya of Axis Securities. Rajesh, great to have you on the show. This is the first time we are meeting this year. So wishing you a very, very happy new year and great to see you this new year. But the market did start the new year on a good note. But since Friday, we've seen this whole selling pressure coming back in. Yesterday, we did try to make some bit of a recovery, but that turned out to be feeble, so to say. And we are still below that 200-day moving average level of 23,915 or thereabouts. Here on, do you think the confidence will be lacking till that 200-day moving average level is reclaimed on both the indices? And where do you see the index today?
Good morning, Nandita, and wish you a very happy new year to you also. Market are volatile since last couple of months, and the same behaviors we are seeing in this new year 2025 also. Until the Nifty not crosses about 24,000 level, 24,200 level on a weekly closing basis, I think this volatility is likely to be there as confidence is still low on the street in terms of large cap as well as on the index front at this juncture. Looking at the near-term behavior, 23,500 to 23,900 is the broader range for the Nifty since last couple of days. Either side breakout will decide the major direction for the market here on. As you already mentioned that we are trading below 200-day moving average for both the indices Nifty as well as for the bank Nifty. So that's giving some bit of cautious to the investor as well as to the trader also. Though we are in oversold trajectory for most of the large cap stocks as well as most of the sectoral indices are in oversold trajectory. Put call ratio is also 0.80. So that clearly shows that shorts are there in the system. So we cannot rule out pullback action from here onward. So till 23,600, 23,500 are intact, I think one should try to buy minor dips near to those level. So at this juncture, if we get opportunity around 23,650, 600 zone, one should be ready to buy with stop loss of 23,500. On the higher side, 23,800, 850 are the immediate supply zone for the Nifty, so where they can book profit. For Bank Nifty, 50,500 to 50,600 are the key supply zone. Until a Bank Nifty not crosses these level, we may see some pressure to be there in Bank Nifty for any minor pullback action. On the downside, we are almost trading near to the November swing low, which was at around 49,800. So that level needs to keep on a watch, because if we breaks below 49,800, then fall can be, substantial on the Bank Nifty also, and we may see further more downside. So for both the indices, I think it's a range bound activity is happening in the market. Stock specific action is the focus area at this juncture. A lot of stocks are doing good. So I think one should focus more on stocks rather to play on the indices. But yes, for Nifty, you can buy near 23,600, closer to that level with stop loss of 23,500. So Nifty, I think may give some pullback from current level.
Okay, those are the levels to watch out for, and 23,600 around those levels you can look at buying. But getting in your thoughts on the new entrants in the F&O universe. You have stocks like Gland Pharma, stocks like NBCC, Phoenix Mills. These stocks have been included in the F&O universe from the 31st of January. We had 45 new additions recently, right? Within the new additions, any stock that is looking worth taking a trade on right now?
So I think most of the stocks are sideways, nothing great as such in terms of technical trend. If at all anyone wants to pick a stock from this new entrant, which is going to come soon, so I think Gland Pharma can be looked at as stock is holding the upsloping trend line support area. So I think if you get Gland Pharma manages to sustain above 1800, I think some pullback action towards 1950 to 2000 we can witness in Gland Pharma. So that stock is looking attractive. On a Phoenix meal, I think 1650 to 1700 is the immediate supply zone. If it crosses those level, then there could be a chances of a rally to extend, as overall structure for Phoenix meal is on the bullish side. Stock is witnessing some profit taking, but I think if stocks crosses above 1700, then we may see a sharp rally towards 2000 level also.
Okay, those are some of the stocks, the new entrants in the FNO universe that you can keep on your radar. But on that note, we are just about getting the first ticks. 9:15, we have the opening bell, and a flat start as was being expected. Just about the Nifty, in fact, is flitting between the green and the red zone. No clear trend as of now, of course, just the first ticks, but it is a very quiet start, and we are struggling for direction at the start of trade. The mid cap index also in the red, no big moves to really point out at the current juncture. The Nifty Bank index has also opened up with negative bias, 100-point lower on this index, just about hovering around that 50,100 mark. In terms of other sectoral movers, want to see what the IT pack is doing. That was the only sectoral laggard yesterday. Ahead of TCS numbers tomorrow. So just want to see what the IT pack is up to at the current juncture. If we can bring it up on the screen, yesterday we saw 7/10 of percent, kind of a loss on the index. Today, the IT pack is trading with a negative bias once again, 0.5% lower on the IT pack. Autos have managed to stage some bit of an extension of gains, very flat but trading with a positive bias. FMCG also trading with a positive bias at the current juncture, but pharma pack particularly doing well, 0.6% kind of gain coming in there. Realty also on a firm wicket as of now. Among the laggards in terms of sectoral movers, you have Nifty Bank, as I already pointed out, around the 50,100 mark. What's not doing well is also the metal pack, trading with a negative bias. PSU banks as well out of favor. So largely a mixed to flat open right now. Let's see how we really pan out as we move forward in the day. But for now, in terms of individual movers, you have Dr. Reddy's. That stock is up and about 3% gains coming in there. Perhaps that's what is pulling the pharma index up in today's session. Dr. Reddy's, in fact, has earned a not a double upgrade, an upgrade from Nuvama. It has been upgraded to buy, and the target price is at 1,553. I beg your pardon. Nuvama has pointed out that the generic Revlimid patent will expire in 2026, and that could be a big threat to the earnings growth of the company. But there are a couple of new launches, the new launch pipeline in US and Canada. These may offset the kind of revenue loss that the company will face due to the expiry of the patent. So yes, that upgrade boding well for Dr. Reddy's. The stock is up 3.5% as we speak. So heading higher. ONGC extending its gains from yesterday. CLSA had upgraded the stock. Reliance Industries, that's one stock that's doing well. We have some positive brokerage notes on this stock, and the stock is clearly reacting to that. Eicher Motors, Maruti, M&M, so some of these auto names also doing well. Aside of that, if you look at some of the laggards on the index, Trent extending losses from yesterday, Shriram Finance, Bharat Electronics, JSW Steel, Hindalco, so some of the metal names also under pressure. Tata Steel, which reported its third quarter business update, is also under pressure. But looking at the open, no clear trend as of now. We are trading with a negative bias, yes, but no big cuts there. What would you be recommending in terms of stock picks, Rajesh, looking at the kind of open that we've had today?
So I think some of the stocks from the pharma healthcare space are attracting the eyes. Lalpath Lab is looking bullish. I think this stock can continue furthermore upside. 3160 to 3180 would be the next target on the high side. As a stock manages to cross its important moving averages, so I think one can look to buy this stock with stop loss of 3065. Another stock where we are focusing, that is on the insurance space, that is SBI Life, can be looked at. I think this stock is in process to form a bottom after the correction. I think if it stocks continues to hold above 1445, there is a possibility that this stock can continue furthermore upside to 1500 to 1510. So SBI can be looked at this juncture to buy. And I think on the sale side, Tata Power, one can keep eye on shorting opportunity is there in Tata Power, as a stock is continuously making low top, lower bottom formation, and short built up is there in derivative data. So I think if it's sustained below to 382 in futures, so I think there is a possible target on the downside to we can see towards 360 to 355.
Those are some of the recommendations. Hope you've taken note of them. But let's talk about Dr. Reddy's as well. As I pointed out, Nuvama has upgraded the stock. Target price is at 1,553 rupees or so. The stock is somewhere around 1,400. In fact, came very close to its 52-week high of 1,421 or thereabouts. It has been doing quite okay. If you look at the last 1 month, it has gained somewhere around 12% or so. But do you see the possibility of a fresh breakout on the charts here on Dr. Reddy's?
Yeah, so stock is looking bullish, and if we analyze on the daily chart, stock is trading in upsloping channel, and stock has in this correction, stock has taken the support from its upsloping trend line, and I think the way stock has moved up in today's session, there is a possibility that stock may able to give breakout above previous swing high, and I think if it continues to trade above 1400, 1410 zone, there is a possibility that we may see a target towards 1480 to 1500 kind of zone in Dr. Reddy. So series of higher top, higher bottom formation is there. So stock is looking attractive. One can hold on their long position, as pharma is also showing good traction. So with stop loss of 1360, one can hold the position.
Okay, that's the view on Dr. Reddy's bullish signals on the charts. But what about Tata Steel? In fact, the entire metal pack, off late has been under pressure. Tata Steel in particular, I think if you look at the 6 month returns, it's lost somewhere around 20% or thereabouts. There's a third quarter update that has come in when India production has grown 6% on a YY basis, and in India deliveries also have grown somewhere around almost 9% or so on a YY basis. But the UK deliveries are down 12.5%. The stock, of course, out of favor today, among the top Nifty losers, 6th or 7th top Nifty loser right now, almost 1% down. But given the fact that it has been stuck in a downtrend for quite some time, would you bother looking at this stock at the current juncture from the metal universe, or would you look at something else?
So structure is weak for Tata Steel, and series of lower top, lower bottom formation that clearly shows that there is a sustained supply pressure is there in Tata Steel. So I think I'll avoid Tata Steel at this juncture until the stock not crosses above 155. Trend is likely to exhibit on the bearish side only. And I think if it's remain below to 136, possible down move can extend to 125, even 120 kind of level also for Tata Steel. So I think at this juncture, avoid Tata Steel. If you want to play some buying in metal space, so I think one can look to buy Vedanta. That stock is looking stable, though stock is still consolidating. But I think on a longer term time frame, stock is holding the support around 425, 430 zone. And I think since last couple of months, stock is consolidating in range only. So once broader market start recovering, Nifty starts recovering, I think Vedanta has potential to again, recover back to 470, 480 zone on a positional perspective. So one can look to buy Vedanta with a positional stop loss of 425 on the metal pack.
Okay, that's the view. Vedanta looking good from the metals pack, but I want to get in your thoughts on Reliance Industries as well. The stock is showing good traction. Yesterday as well, it was among the top contributors to Nifty's gains, although the stock has underperformed, in 2024. But some of the brokerages have pointed out that 2025 could be a recovery cycle for the company. In terms of risk reward, how are you viewing Reliance right now?
So I think if one can follow a stop loss of 1200, that is almost 4% lower from the 4 to 5% lower from the current market price, then one can try to buy some, staggered buying in this counter, as a significant correction we have already seen in this stock. And from the lower level, 1200 is immediate support area. So I think if it's able to hold 1200, recovery can continue towards 1300 to 1350. Once stock crosses about 1350, then we may see a confirmation of bottoming out, and then we may see further more upside going forward. But till the time, I think 1200 is intact. One can try to buy near to 1200 with stop loss should be placed at 1190. On the higher side, 1300 to 1350 are the positional target for the stock. But still, buy in a staggered manner. Don't buy in one go.
Okay, that's the view. Then on Reliance Industries, before I come to queries, in fact, actually, we also have a couple of queries on Zomato, which saw a significant 5% cut yesterday, and today as well, it is extending its losses. The stock has not been doing all that well. And if you look at the last 3 month performance, but there is news flow around the company. The company has stepped into the quick food delivery segment with a new 15-minute service, and it is aiming to rival Swiggy's Bolt and other fast delivery platforms. There has been no official announcement as such, but the app, this feature has already gone live on the Zomato app. But given the recent underperformance from Zomato, how would you trade into it? In fact, we have queries from Shweta and Varsha Gajjar coming in. They want to know how they should trade into it. Shweta, in fact, has bought shares at 270 rupees. She wants to know if she should hold or book losses. Her time horizon is 6 months to 1 year.
This is the fourth consecutive day where the stock is witnessing lower low formation. So I think that clearly shows some serious profit taking is happening in this counter. So long-term structure is still bullish. I think in this corrective move, 240, 235 should be watched closely. If at all stock holds 235 in this correction, I think we may see some, buying interest to come around those level as it's an important support area. Multiple times stock has taken the support from these level. So I think 235 is the level where one can keep eye. If it's not breaks, hold the position. In the pullback, 265 is the major key supply zone. If it crosses about 265, I think then stock will attempt to resume its uptrend, and then gradually stock will move further higher to 285 or 290 kind of zone. And then I think then stock may resume its uptrend. But I think let's settle down this supply pressure. 235 needs to keep as a stop loss.
All right, 235, important level in terms of a stop loss. Hope that answers your queries. But let's take up some more viewer queries that are trickling in then. We have a query coming in from Kishore on Ahluwalia contracts and Afcons Infra. Wants to know which one is a better stock to invest in, and wants to know what is a good entry point if he is looking to accumulate the stock, one of these stocks.
I think AFCON, we don't have much data, but looking at the limited data which we have, AFCON is looking attractive as the stock is trading still above its listing price. And I think if it continues to hold above 490, there is a possibility that stock may attempt to give breakout above 550. If its stock crosses above 550, really can extend to 600, 650 zone. So that's the view on AFCON at this juncture. Ahluwalia contract is still in corrective mode until the stock not crosses about 1050, 1100 zone. I think trend may remain on the weaker side. On the downside, if it's a break below 940, we may see furthermore cut towards 880, 850 kind of zone also. So I think AFCON can be looked at with stop loss of 490.
Okay, you can look at AFCONs with the limited data that Rajesh has access to. He is recommending an AFCON. I hope that answers your query. The next query I spotted on an SKF India. This one's coming in from Debu K. Wants to know if this is the right time to invest in this counter. Would you advise SKF just about hardly 0.3% kind of gain today? In the last 5 sessions hasn't really done anything significant, and the last 1 month as well, we've seen a 12 to 13% kind of a loss. 6 month basis, it has lost 30%. Would you recommend this stock? Not very far from its 52-week lows as well.
So I think I would avoid at this juncture because stock is continuously in supply pressure, and now it's trading near to its critical support area. Looking at the structure, there is a head and shoulder kind of formation is taking place. I think if it breaks below 42 and 4250, 4260 zone, I think we may see furthermore downside to extend in this counter. So at this juncture, I'll avoid it until the stock not crosses above 4700. I think one should avoid this counter as we may see further more downside if it's break below 4260 zone.
Okay, that's about SKF. It's an avoid at the current juncture. Hope that answers your query. The next one, I spotted a query on Adani Power. This one's coming in from Pooja Khanna. She's holding Adani Power at 586 and the stock is now at 505. So she's making a bit of a loss here. She wants to know what she should be doing with the stock. Are there any chances of a dash at her buying price anytime soon, because the stock has been under selling pressure in the last 1 month, even the last 6 months for that matter?
So, Adani Group stocks are volatile in terms of nature. There is no sustained buying action is there in most of the Adani Group stocks. I think whenever there is some positive move, it's fizzle out very soon. So this is the same behavior is happening in Adani Power also. Looking at the near-term, short-term structure, I think 560 is the key hurdle for the stock. If it crosses, then there is a hope of recovery to 640, 650 zone. But looking at the near-term, short-term structure, I think it may take time. So if you have a little longer time horizon, then you can hold on the position. But again, one thing one should keep in mind, these Adani Group stocks are very volatile in terms of nature. So if you have appetite to digest these kind of volatility, then hold on the position. On the downside, at this juncture, 485 is the key support area. If it's hold 485, then there is a possibility once market stabilize some recovery, we may see towards 560. And then one should watch that 560 level, whether the breakout comes above that level or not.
All right, that's the view on Adani Power, but just about enough time for one more query then. Let's take it on a Cocoyu Camlin. This one's coming in from Satya CK, wants to know if it can be averaged at current price and what is the expected target in the next 1 year. The stock has been in a clear downtrend. In fact, in the last 1 year as well, look at the stock, it's down somewhere around 13% or so, and it's not, in fact, it is actually approaching its 52-week lows as well of 109 or so. Do you think, from a risk reward perspective, it's a good time to accumulate and wait for the next 1 year for a recovery to come by?
So, my advice would be stock has already corrected from its swing high and approaching towards its important support area of 115, 110 kind of level. So, if at all, if you are averaging out at this juncture, keep a stop loss of 110, whatever quantity you are buying it for average out. Because if it breaks below 110, then I think we may see cut towards 95 level also. On the higher side, 145, 150 are the major challenging level to cross. Until the stock not crosses 150 level, we may see, stock to remain in the range only 110 to 150 would be the range for some more time, as he has a time horizon for 1 year. So I think if you are averaging out, keep a stop loss of 110, whatever quantity you are buying it for average out.
All right, that's the view on Cocoyu Camlin. Hope that answers your query. But with that, we've come to the end of the query segment. And Rajesh, would like to thank you for taking out time and joining in this morning. It's always a pleasure chatting with you, and I look forward to interacting again in the future.
Thank you.
And on that note, quickly take a look at the market. Not much movement since the open. We're just about 60 points down on the index, although we have broken below that 23,700 mark. Let's see how we really pan out as we move forward. But on that note, let me get on board our next guest for today. Joining me is Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth. Feroze, great to have you on the show. Want to wish you a very happy new year. This is the first time we are meeting this year. Hope you have a great and prosperous year ahead, and one that's also one that also enables you to travel a lot more, because I've been going through your Instagram feed. You have been traveling quite a bit any which ways, but good to have you on the show. The new year hasn't been all that great in terms of the market movement, right? We had the HMPV scare, knee-jerk reaction. The recovery from Monday lows hasn't been all that great. Is it time to be fearful, in terms of the volatility that we are witnessing, or is it time to be greedy and look at this as a buying opportunity?
Uh, uh, Thank you, and wish you the very same. Wish you a lot more travel as well, and your viewers as well. 2025 can be a very good year. Every year can be a very good year. Depends on what our resolve is for that particular year and how determined we are to meet that resolve. And I wish each viewer a great success in 2025. Now, coming to the pointed question, is the market fearful? Is the fear real? What are the risks involved? Firstly, I think that the fear was real. From 27th September 2024, if you've come down almost about 10% today on the index level, which is Nifty index, and almost about 8-9% or even more on the NSE 500 level. So you're not going into this new year at the peaks. You're going at practically the 2024, not 24 troughs, but yeah, 7-8% more than the troughs. So point one is, don't be so fearful because a lot of it has been done already. The damage is done. So markets have consolidated here. That's point one. How do you check whether it's consolidated or there is more pain? You can check that by checking 4 different measures, which is what we do. Maybe these are not crystal ball gazers, but they practically try and give you a better sense. FII short position is at 19% yesterday, which 81% yesterday in the index futures. They have already finished their shorts on index futures. That's the mid-cap index. That means that there's a lot of selling on the futures market already behind us. In the cash market, FIIs have been sellers. In December, they were positive. So selling cash market and selling of FII is also reasonably done. And when I spoke to FIIs on a one-on-one conversation, at least 4 or 5 of them, they said we were just rebalancing our portfolio between India and China because India had done better, China had done worse off. They also said that they've added a lot of shares in the small cap space. That's why we've been bullish on small cap through the year. Now coming to the last point and the most important point, why you should not be fearful is because India is a limited shorting market. In the top 10 economies in the world, you will not find this attribute in any capital market. There is a limitation on short positions in India. So you can't just wake up one morning and say there is a virus coming, I want to short India. Not possible. 500 crores is the limit. So no big boys can come and sell futures just assuming to make money on the downward trend. Unlike in real estate, you can't short real estate. I can't sit in this building and say I want to sell 20 houses when I don't own them. But in equity, it is possible. That's limited. So these are the 4 reasons why I would say you don't have to be too perturbed as long as you're okay to weather the volatility of about 5-7%, 8%, which I think is business as usual for equities.
Right. The next key, factor to watch out for, would be the third quarter earnings season that begins tomorrow. And you also have, the budget that's on the 1st of Feb. Are there any chances of, a pre-budget up move or rally? Or do you think since third quarter earnings starts tomorrow, a lot of reaction will be, on the basis of the kind of earnings that the companies report. So a pre-budget rally, could that be looked at or is that completely ruled out?
Pre-budget rally is not ruled out at all. When you are oversold, both in the cash market and the futures market, there is a pre-budget rally possible. That's exactly what happened on Thursday, which was the last expiry. Markets got short squeezed. That's where you saw 457, 460 points up move on Nifty on an expiry day. So when you are in the oversold territory, this is one of the barometers to see if you see the last 2-3 expiries, if there is immense amount of short covering happening, that implies that you're already in an oversold territory. So can there be a budget as a reason for a bounce back? The answer is yes. Will that happen? Don't know. But can it be one trigger or a catalyst to this experiment or the chemical reaction? I believe yes. So I personally think that yes, pre-budget rallies are possible because of some degree of optimism which comes through before a good full year budget.
Right. Last month we saw, FIIs turning buyers, right? And, if you look at the NSDL data, foreign institutional investors have loaded up their portfolios with IT stocks, with worth over $1 billion. In fact, out of the net investment of 15,400 crore rupees or thereabouts by FIIs in December, about two-thirds went into IT stocks. Of course, third quarter is seen as a seasonally weak quarter for IT names, right? Barring perhaps say HCL Tech, which the products business does pretty well in the third quarter for this particular company. But we know that the rate cut path in the US is uncertain given the kind of strong data that came out last night. In terms of all these factors, do you think IT is a good space to be in right now?
Yes, Nandita. See, what happens is, like you rightly said, the third quarter is a seasonally weaker quarter. But still, FIIs are loading up IT stocks because capital markets always are at least 6, 8 months, 9 months ahead. Sometimes they are 2 years ahead. Sometimes they are 1 month ahead. Capital market and prices generally discount earnings in the worst situation 1 month ahead, in the best situation almost 2 years ahead. So you're absolutely right. So FIIs will go a little ahead of the curve, especially given the valuations being stretched in several other sectors. So yes, it's a good time to gobble them up, especially mid-cap IT is what I would speak of. But secondly, see, very importantly, if you're looking at demand and supply, giving you some indication of creation of portfolio, I think we should look at the DII more keenly, because you look at almost 360, well, $60,000 rupees, which is 3.6 lakh crores, came into equity mutual funds net. SIP number is very well spoken of, but the problem is people speak of SIP numbers and not speak of the net number. So there is about 3,61,000 crores which has come in the first 11 months. In the previous year of the calendar year, which is calendar year 23, you saw 1,61,000 crores, which is a 118% jump. If one of the big boy, which is DII, is getting inflows, and if I'm going to follow them for my portfolio creation, then those are a better barometer for you to create portfolio, because those are the guys who have deep pockets today. FII, perception-wise, globally, they have deeper pockets than DII, but DII is the bigger boy for the Indian capital markets, or a bigger girl. Let me not be biased towards one gender, especially speaking to you, Nandita.
Right. I also want to get in your thoughts on the, first advanced estimates of GDP that came out yesterday, 6.4%, not a shocker on expected lines. But there seems to be, all the high frequency indicators pointing to a slowdown, at least in the short term, short to medium term, if not the long term. Your thoughts on how one should be navigating, the consumption sector, or even the manufacturing sector, so to say, given the fact that, the estimates for manufacturing have literally been halved. So, against the backdrop of the kind of estimates that have come out, what are your concerns?
See, my concerns are not too many on the economy side. From a short-term standpoint, because I've mathematically tested all these high-frequency data and their correlation as a lead indicator to market in the future. And I was very disappointed with their predictive capability of the near future. Economy is a great predictor of the long-term capital market story. For example, in 11-year periods rolling, GDP and nominal GDP and Nifty growths have almost converged to each other. But GDP and its economic variables predictive capability, if Nandita is wanting to know in the next 1 year, it's a very poor lead indicator, and I can give you some statistics probably in another show. So point one, economy from a long-term standpoint, I track 7 variables of the economy so that I don't get distracted too much, because economy is such a wide spectrum of data that you can convince somebody to be positive and somebody to be equally negative at the same point in time, because the data points are so enormous. So I've tried to fix the goalpost of those 7 variables, out of which one of them is in the red. The rest of them, 4 of them are in deep green and 2 of them are in green. And the one which is in red is what I think you also alluded to. That's the flat yield curve in the Indian debt market, which is a big dampener to the banking space. Because if Nandita's dad or my dad were given an FD rate of 1 year of 7% and 5 years of 7%, he always chooses 1 year of 7%. That is making the bank's job tougher, because my dad needs to be convinced 4 more times to roll over his money. And that's why deposit growth has got hampered. Unlike the narrative that equity mutual funds are taking away all the money, that's why deposit growth is low. Equity mutual funds have only taken away 3.6 lakh crores, which is not even 7% of India's household savings last year.
Last question really, there has been a slowdown in the demat account growth. In fact, it had fallen to a 4-quarter low in the December quarter. Do you think, it is the start of a broader trend, or do you think it's just a one-off? What's at play here?
Nandita, I look at it like this, that independent demat accounts can't tell you the full story. It's like interval ke pehle ki kahani. You have to see it in conjunction with another kahani, which is, if the demat account opening has slowed down, but it's still opening, not closing, it's still opening, then if you see it in conjunction with net flows or SIP numbers with equity mutual funds, which are a reasonable barometer for sentiment, direct equity and mutual fund, both are retailish platforms to open a demat account for free. I am seeing the demat growth reducing, with a reasonable growth, which is 41,000 crores in November in net flows, which was the second highest month for the full calendar year. So if I saw demat degrowing or slowing down, and if I see net flows in mutual funds coming down, then it's a scarier picture than one of them. So it speaks of people moving from direct equity to mutual funds, which is what I would ideally want to pray for Indian retail.
Okay, point taken. And lastly, what are your expectations from the budget? Any wish list? Would you like to share that with us?
My only wish list is, I hope I don't see another big tax change. Because Nirmala ma'am, when she was reading out the interim budget, she changed taxes for all assets practically, from private equity to unlisted share to real estate to indexation to equity to unlisted debt. And then she also made one statement saying that I'm going to bring in a full comprehensive tax code change. If that was the case, then that change was not warranted on 23rd July 2024. And I just wish and pray nothing changes so that we can get acclimatized to the new temperature.
Right. Let's all hope that there aren't any, big changes on that front. But with that, Feroze, would like to thank you for taking out time and joining in. I wish you a very happy New Year once again, and I look forward to interacting more often going forward. Thanks a lot for joining in this morning. Well, on that note, just taking a look at the market, we were at, when I last did a market check, just about 60 points down on the Nifty, below that 23,650 mark. But as long as we don't test those December lows of 23,460 or thereabouts, I think, we should be better or okay, so to say. But once that level is broken, then we could see some serious sell-off. That's what experts believe. But for now, we are, below that 200-day moving average level. And as Rajesh pointed out, 23,600 to 23,900, that will be the broad range to really watch out for. And of course, the big trigger for the market henceforth would be the third quarter earnings that kick off tomorrow with TCS reporting numbers. And of course, then we have the budget as well on the 1st of February. But with that, completely timed out. The mid-cap index, however, has seen, an over 1% cut coming in. So, as we speak, the, weakness in the broader end of the market seems to be deepening, because the advance decline ratio is also, firmly in favor of losers. Not looking great. On the NSE, it's 1:3. That's the advance decline ratio. 578 shares gaining to 1,700 shares declining. So, yes, the breadth has worsened. The mid-cap index has shed over 1.2%. So, yes, looks like we are in for a weak session. But let's see how things really pan out. But for now, it's a goodbye from me. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and come back and join us at 3:30 p.m. on Closing Bell as well.